All right, everybody, ladies and gentlemen, good evening and welcome to us here at ATFX. My name is Philip and I have the honor and pleasure of being your presenter for tonight's webinar. Tonight we want to have a look at 7 advanced risk management techniques. And why do we want to use those risk management techniques? What are they good for? And how can we essentially tweak the markets a little bit in our favor, so in the end that we have an opportunity to make money in those markets. Once you look at your webinar interface, you see that small questions box, and right now I would appreciate a very short yes or why in that set box to just let me know that you guys can hear me well, that you actually saw the screen change, the slides changing here, and so that we have sorted the technicals out and are up and running, and this looks good. Thank you very much, everybody who gave me that feedback. And please, guys, by all means, I love those sessions to be interactive, which means if you happen to have any questions, please put those questions into that box. You're not interrupting my flow. It's not some kind of annoyance for me. I'm really looking forward to answering your questions. Obviously, I know already everything that I'm telling you guys here today. And my goal really is to help you guys to understand those things. And please, if something is not clear, don't be shy, ask questions. There are no stupid questions, especially not when it comes to trading. Tonight's webinar is scheduled to run for around about 1 hour. And of course, before we get started, there are the usual risk disclaimers. You already do see those here on the screen. Please, I have to make you aware of those. Please take a moment of your time to read through those and make sure that you're okay with them before continuing the webinar. Essentially, this says that trading, of course, involves risk, and we want to manage that risk. That's what we're here for today. And so we want to first understand those risks, and we want to understand the risk structure of the instruments we're using before we're getting into the market. As neither ATFX nor Trade with Position nor myself are registered investment advisors, nothing that we say should therefore be considered to be actual investment advice. All examples are shown for educational purpose only, especially true for the live part of tonight's webinar. We will be looking at the markets together. I want to explain to you guys what I see on those charts, but it's just that it's what I'm seeing on those charts. And I have to disappoint you, I don't have a crystal ball. I don't know what's coming next in the markets. I don't know what the president will tweet out next and what the impact of the markets will be. I don't have a clue. The only thing that I can do is change and address those things which I can address, and we will cover all those here tonight in this webinar. So once again, everything that I show you is just for educational purpose. It's just my opinion. It's just my spin, my take on the markets, but this can and will be obviously wrong, not only from time to time, but frequently. But that doesn't matter, because even with frequent errors, we can make money in the markets. And tonight I want to show you guys how I approach the markets in order to do that. So that being said, please make sure you're okay with all this. And without much further ado, let's just get started. Today's agenda, it's really, we want to focus on risk management techniques. What is a proper way to approach trading? I still know when I approached trading for the first time, I had my funded account and all this was rather interesting and intriguing, but honestly, I didn't have a clue. I didn't have a clue about nothing. It was just, I liked a certain company, a certain Forex pair, and I just traded that one. Why did I trade it? How large did I trade? All this, I didn't think about that at that point in time. And it was just the long road of learning, the school of hard knocks, until I figured it out. We have several aspects, several areas that we have to think about and to take care of when it comes to trading in order to be sustainable, in order to give ourselves the opportunity to survive today's market action and to be in for the long run and to make money in the long run. So how can you incorporate those risk management ideas and plans into your everyday trading? Real-time analysis of the live market showing you how to implement those advanced risk management techniques. And of course, we want to wrap up this session. Tonight's webinar is brought to you by ATFX. So guys, if you haven't opened or funded that account yet, please consider doing so. And to close this session, we want to give you some ideas of why ATFX might be the proper and right broker for you to trade the markets. So without much further ado, let's just directly jump over here to the live platform and have a look at what we see in the markets. Right now, I'm looking here at a chart of US oil, which is of course WTI, crude oil, United States. And we're looking here at a daily chart because what I want to show you here, it's applicable to any time frame and any market. That's really crucial. It's not something specific about oil, which I want to cover tonight. The same logic, the same ideas, the same principles will be applicable to oil on a 5-minute chart, to Forex on a 5-minute chart, on a weekly chart of the S&P 500, on a 1-hour chart of the S&P 500, treasuries, Forex, commodities, you name the market. Everything that I teach you guys here tonight is really universal. I don't care about the market and I don't care about the time frame. It's all the same. One size fits all. I find this rather crucial because if somebody tells me he has found the perfect system for gold, but it completely falls apart when he's applying that same strategy to Forex or to crude oil, for example, or anything else, that just doesn't make any sense to me. Because guys, what we're seeing here on this chart is, yes, it's price action, but price is just the observable result of people acting in the markets. So essentially what we're seeing here is the result of people trading. And people trade for various reasons, but in the end, they have to agree upon one thing. They have to agree upon price. At a certain point in time, people have been trading and we can see that price on that chart. And for that is really crucial, for me, therefore, it's really crucial to understand what is it that I see here on that chart. And let's make the chart a little bit larger. Because here I can see the momentum of the market, what people have been doing, and therefore what people might be more likely to do than not. Trading is all about stacking odds. And this idea of being able to read the price action and understand what we see there and identify certain patterns, this is my first risk management techniques. I want to have an edge. I want to see what people have been doing, and therefore I want to see what's rather more likely than not to happen in the future. This is not the crystal ball. This is just talking about probabilities. It's all about probabilities, guys. I will never be able to know for sure what the market will be doing next. And therefore, as I don't know what will happen next, the next trade, although it looks perfect, can be a winning trade or it can be a losing trade. We have two components that help us to make money in the long run. The first component is I want to win more often than I will lose. And if somebody tells you they have that perfect strategy, which has only winning trades, personally, I would take my money and run like a thief in the night because I just know that's not true. I know it's so desirable to have a strategy like that, and it just doesn't exist. We have to start to think in probabilities. So stacking the odds, identifying things on those charts which help us to win those trades more often than not, that's the crucial first component. And the second component is, if I win my trades, I want to win bigger. Which means if I'm risking 100 pounds on the next trade, it doesn't make sense for me to close that trade if I'm up 20 pounds or 50 pounds. I just risked 100 pounds to put that trade on. And therefore, I want at least to be able to make 100 pounds on that trade, preferably 200 or 300 pounds. So I want to have a multiple reward to risk ratio on that trade. Multiple, it should be at least one, preferably larger. And those two things coming together, winning more often than losing and winning bigger, this is how we make money in the markets. That's the big plan. And therefore, the first thing, I want to win more often than I lose. And part of that is I want to look at my chart and understand what I see here. What is it that can give me an edge here? And I don't want to focus too much on this chart reading aspect here tonight, but I want you guys to understand this is really crucial. I'm not just jumping blindly into the market. I want to have an idea. I want to have a plan. More about the plan in just a few more moments. But the first idea really is I have an idea that this market in this whole area might be going higher. So why do I have this idea that the market might be going higher? We are here in the context of an uptrend. Why is it an uptrend? Well, price is making higher highs along the way and also higher lows. Simple as that. I don't need any fancy indicator for that. It's just I eyeball my highs and I see the market is making higher highs, and I can see the market is making higher lows. Simple as that. So the big picture here is the market is moving up. Why is this crucial? I talked about people acting in the markets, and I feel that if people have been buying for some time, they will be likely to continue buying in the future. The way that I would like to see it is just like in standard physics, Newton's laws of physics. If something is in motion, it stays in motion unless an opposing force is applied. And people, the momentum in the market here is clearly going towards the upside. People have been buying. Let's zoom out a little bit. Here, obviously, the market is falling. I see the market is making lower lows and lower highs. It's just like a huge rock. That rock is sitting on top of the mountain and it starts to move lower. Guess what? It takes more and more effort once that rock has started to roll down. It's getting faster. It's accelerating. And at one point, it has to stop, but on all the way down, this huge momentum, momentum is within that rock. It stays in motion, and it takes a lot of force to stop that rock coming down. And therefore, if I see the market is falling, I feel that it's safer to join this market on its move to the downside than try to pick the bottom. If I want to pick the bottom, I'm just standing there, very brave and maybe very foolish, and I see this rock rolling towards me, and I think I know where you will stop. Yeah, it can work out or not, and the not scenario definitely is not so good. And why take the risk? Why not just say, okay, this rock is going down, let's join this rock on this move down. This market is moving higher, it has momentum towards the upside. Why not join this move towards the upside? Stacking the odds in my favor, making my favorable trade outcome being more likely than not. We are not talking about, all right, this is an uptrend and therefore I have now an 80% probability that this market is going higher. We are talking about small probabilities here. So maybe from a pure random trade outcome, 50-50, I might be moving my trade outcome now to 52 to 48, maybe 55 to 45, something like that. And therefore, one factor that I've identified is never alone good enough for me to actually open that position. I want to stack the odds. I want to gather multiple reasons to take a trade. Other things that I like to see around this chart is I'm seeing the market is in an uptrend, check. And I can also see my moving averages fanning. I'm looking at a 10, 20, 50 and 200 period moving average here. And first thing, once those moving averages are in this order here, and especially I'm focusing on the 10, 20 and 50, I know this market has to be in an uptrend, and it has to have been in an uptrend for some time, because otherwise I wouldn't see that structure. You see, the market is just stopping here at the bottom and starting to move higher. The 10 is below the 20. Now it's just crossing above it. Here in this whole area, those moving averages are all over the place. It's not really clear where this market is going. But just a few days later, I can see structure has evolved. The structure has cleared up. It has become more apparent. Yes, this market is moving higher. First use of those moving averages, I want to see this fanning pattern, because this helps me to quickly grasp and realize, yes, we are in a trending environment. The next thing that I would like to use my moving averages for is I want to see that price has pulled back to what we like to call price equilibrium levels. This is just a fancy way for saying price is returning to its averages. Price can never ever move in one direction without stopping. It's just like you guys out there doing sports, sprinting. At one point, you can run as fast as you want, but at one point, no matter how fit you are, at one point, you have to stop and catch your breath. And this is exactly what the market has to do again. Price is pushing higher, and then it's either pulling back or it's moving a little bit sideways until those moving averages have caught back up again. Think of the real estate market. Real estate prices, let's assume real estate prices are soaring higher. Does this mean you want to buy real estate? Yes, probably you want to buy real estate. But do you want to buy real estate at any price? Absolutely not. You want to buy real estate when you get a good deal. It has to be a good deal. It has to make sense. You probably want to buy something around the average prices in the area where you want to buy your real estate, and not at highly inflated prices. And it's the same thing here. We are doing the same thing. Just a moment here. We got a question here about the recording of the webinar because of internet connectivity errors. No worries. The session is definitely being recorded and shared with ATFX. I'm pretty sure that they will send out the recording to all the attendees here. So no worries about that. I'm pretty sure we got you covered there. But thanks for that question. And just guys, a quick reminder, if you have questions, shoot. Don't be shy. Not interrupting my flow, not intimidating, not whatsoever. By all means, ask questions. Okay, so I don't want to buy highly inflated prices. I want to have a good deal. And I'm using my 10 and 20 period moving average here to help me to identify this good deal area. And this is just, you see, prices pushing higher and it's pulling back. Where is it pulling back to? Into my good deal area, the 10 and 20 period moving average. We like to call it the buy zone in an uptrend or the sell zone in a downtrend. And you can see this happen pretty much all the time. Really all the time? No, obviously not. But more often than not, and this is what we want to do, stack the odds, help us to see and combine factors which occur more often than not. And if we have a lot of more often than not, suddenly we really have a significant edge. Then we have moved from 50-50 to maybe 60-40 or maybe even 70-30, which still means that we can lose on 30% of our trades. And now we must make sure that we easily survive those trades. So the idea is I want to find multiple reasons to take that trade, stack the odds in my favor. Divya, and I hope I haven't butchered your name. If so, I'm sorry about that. So I asked the question, what does this black and blue line interpret? It's just the average price of the close of those bars. It's a simple moving average. You can use an exponential moving average if you want to. The basic idea, the interpretation of those lines does not change. This is just the average price, the average closing price of last 10 bars, the average closing price of last 20 bars. And this helps me to easily see what price has been doing for some time over different time frames, if you want to put it like that. So rather fast time frame, a little bit slower, medium-term time frame, 200 bars, long-term time frame. And it's the same across all different time frames. So if I'm moving from a daily chart to a weekly chart, the settings absolutely stay the same. This is not adjusted for time frames. Here I'm looking at a 10-week average price versus a 20-week average price, a 50-week and a 200-week average closing price. So those stay the same. Same is true here for a 15-minute chart, for an hourly chart, and so on. And guys, I hope you can see that here on this daily chart, beautiful uptrend. And if we compare this now to the hourly chart, I hope you can see that the chart structure is completely different. I don't really have an edge here with my chart reading skills. My strategies obviously are trend following strategies. I want to see something moving. And here I don't see something moving. I see this market is moving sideways. No clear structure of lows and highs. No higher highs, no higher lows, no lower lows, no lower highs for a downtrend. This is sideways. The only thing that I can see here is, yes, we have volatility compression. Those lows are rising, the highs are pretty much falling. This is not the environment that I look for my strategies. Moving averages pretty much all over the place here. No clear structure. Compare this with the structure that we had here in this area. So those things coming together. We have multiple reasons to take a trade. And now we want to plan our trade. It's a bad idea usually to just look at this chart and realize, yes, I want to buy this market at that point in time here. Let's just do it. I buy with everything that I have and then some more. Hooray for leverage and margin. No, I want to have a precise plan. I want to have the precise plan of what to do, when to enter. We like to call this, and this is my second risk management technique here, I want to plan my trade and then just trade my plan. The basic idea is I know that humans, and I'm especially, we are rather emotional beings, which means we can think rather clearly if nothing is on the line. But the very moment I have a position on, I have the risk of losing, I have the fear of missing out. At that moment, suddenly my decision-making process is no longer as good as if I was just consulting somebody or if I hadn't that position on yet. And that's the reason why I want to have my perfect trade plan laid out before me. I want to know exactly where I want to get in. I want to know exactly where I want to get out if things don't work out. And I want to know where I get out if things are going my way. And guess what? When I started my trading, it was just a journey. It was that I learned from step to step. Oh, yeah, there's one missing piece of the puzzle. I have no clue when I want to sell this position. Oh, the market's going against me. I'm taking the heat right now. Is this good? How much more can I take? What's going on there? So just a second here while I'm catching up with the questions. All right, Simon is asking, same principle for momentum breakouts? Yes, absolutely. The basic idea is, even if I have momentum breakout trades, I want to see that the market is in the context of a trending environment, because the basic idea is once we get the breakout, I want to see that the market pushes on in this original direction of the trade. And if I don't have this trending environment there, doesn't make any, I don't know, the market doesn't really have that urge to push further in one direction. And I'm missing the most basic assumption about my trade there, that we are in a trending environment. All right, we mentioned the period of the moving averages, which was 10, 20, 50, and 200. Question about adjusting those indicators per each time frame. I could do it manually, but I don't want to do it. I want to keep those settings at the same, because the interpretation would be just has to be the same. So, guys, by all means, keep the questions coming. Sai is asking a great question. How many such higher highs and higher low patterns have to be created in order to determine that this is a good trending environment? Guess what? Just one. The very moment the market makes a high, it creates a higher low and it pushes on to make a new higher high. At the very moment, and let's grab a line here in order to visualize this a little bit better. The very moment price is breaking this high on this candle here, that's the very first or latest moment in time that I know, all right, I don't know what the trending environment was before, but from this point onward here, we are in the context of an uptrend. Would I immediately look for a long trading opportunity here on this daily chart? No, I wouldn't, because I would want to wait a little bit longer to see that the moving averages, at least the 10, 20, and 50, have fallen into place. But from just to label the trend, that's the first time that we definitely will see or have seen a new higher high here. So the trend at that stage has shifted to an uptrend. Might not be enough to take that trade. Remember, stacking the odds, but from this point onward here with this candle, I know the trend has changed to an uptrend. Question about MACD. Very brief idea here about MACD. With MACD, I want to see that I just use MACD to assess trend strength and trend health. So I'm just using it for scanning for convergence or divergence. is a little bit off topic, but the basic idea is I could see that price is making a new higher high here. So I could just assume everything is just fine and price will continue to make new higher highs. But I have a second level of information. It's just like the doctor is using an X-ray to look inside your body. And with my X-ray, MACD and RSI, I'm looking inside the strength and health of the trend. And I'm doing this by comparing. This was my previous higher high in price. That's the value in MACD. Let's just mark this value here. So that's the high. So I'm seeing this high here in MACD, and price is making a new higher high. At the next point in time, I can see, wait a minute, price made a new higher high, yet MACD isn't making this new higher high. That's my first early warning sign that something might not be quite right, and I might be a little bit reluctant in order to buy this small bullish candle here. So much just about there, about MACD. All right. George is asking about the difference between MACD and the awesome oscillator, and I'm completely open and frank here that I say I don't have the formula for the awesome oscillator currently in mind, but those oscillators pretty much work the same all the time. It's the same thing with RSI. We're using RSI in just the same way. Higher highs in price should be confirmed with higher highs in RSI. We don't get those. I don't care if the market is overbought or oversold at that stage, because guess what? If the market is in a trending environment, we will see overbought conditions for quite some time. And those traditional interpretations of the indicators might at that stage give us a lot of false signals to follow up on. Just one small statement here. I'm teaching you the way that we are looking at charts and that we are trading the markets. This does not suggest, however, that that's the one perfect way to do it. There are many ways to trade the markets, and I'm pretty sure some of you will sit here now and say, oh, come on, you don't tell me that RSI and the traditional interpretation is not working. I'm making a killing with it every single day, every single month. If that's working for you, all the power to you. Keep on doing what you do. Perfect. Trading can be done on so many different ways and styles. And what I'm showing you here is just the way our style is working for us in the markets. I do not want to suggest that no other style does work or we have the perfect strategy and system. The perfect strategy and system is thinking in probabilities and managing your risk. So I hope that answers that question. So the awesome oscillator, knowing nothing about it, I would just use it the exactly same way as I used RSI, scanning for convergence or divergence. So I want to have a plan. And what is the plan like? Well, price is pulling back here towards my moving average buy zone. And I'm looking for a small bullish candle to trade. So the plan is, once price is breaking above this small candle here, I want to belong the market. First rule, all right, trade entry. Trade entry has been taken care of. Another question here. George, thank you for those questions. First question, can I depend on candles patterns in entry and exit points? And the other one, or depends on gold cross of MAs. The gold cross of MAs, which is the cross of the 50 and 200 period moving averages, by the way, those traditional crosses of those moving averages, you're late to the party. The cross, the trend already has changed. We talked that reading price action, we would have realized the trend is an uptrend back here. The 50 has crossed the 20 only here, and the 50 above the 200 would have taken you to wait until there. So you're late to the party. Those are lagging indicators used in that way. We want to use leading indicators, giving us an idea about what the future might bring. First idea of leading indicator, scanning for convergence or divergence in MACD and RSI, seeing that no, the higher high in price is not confirmed. Something might be slowing down, something might be not working as intended. Sure enough, price didn't move higher and create new higher highs. Essentially, we dropped below the previous low. We made another lower high. We made a lower low. So technically, crude oil just by looking at the trend, has now already shifted to being in a downtrend. All right. Zach Lane asking the good and great question. We will cover those in just a moment. How do you plan the percentage per trade and stop loss? This is where we're heading. So I want to have a plan. The plan is I want to buy the high of this candle, a stop buy order. And the next question is, and that's the third risk management technique, always use a stop loss. So what is a stop loss? If my trade doesn't work out, I have stacked odds in my favor. I think I've identified multiple reasons of why this market should be going higher. But guess what? It's just a probability. And there's always this anti-probability adding up to 100. And this means I can be wrong. And I'm wrong often. I'm right more often than wrong. But still, absolutely speaking, I have many losing trades. But I don't worry about those. Why? Because I know exactly where I want to get out of my trade. And in this example here, with this potential buying candle, buying opportunity, my stop loss would be just a little bit below the low of this candle. I always have my stop loss. Rule number 3. Rule number 4, that stop loss for me has to be in a logical place. In many books you read, oh, with the S&P futures, I'm placing my stop loss just 5 ticks below. I trade those markets with a 5 tick stop. With Forex, I'm usually going for a 20 pip stop. I find those ideas to be horrible because the market doesn't know about your 5 ticks. The market doesn't know about your 20 pips. And 20 pips on a 5-minute chart trade could be a large stop loss. However, on a weekly chart, on a weekly trade with a 20 pip stop loss, you're usually this is just random noise. The market doesn't know about the size of your stop loss and doesn't care about it. Your stop loss, that's at least what we feel, should be in a logical place. And the logical place for me is here. I see that this market is in an uptrend. I see the market has now pulled back to price equilibrium levels. Remember and think of this good deal area. Now, the idea is I get a small bullish candle, and this small bullish candle is sitting in my good deal area. And the idea might be this pullback might be over, and the market might resume in the original direction of the trend. That's the basic idea about this trade setup. And so what has to happen that I realize, wait a minute, I've been wrong. The market doesn't play along, I'm wrong. That's exactly the point in time when this is not the new higher low that I've been looking for. And for that reason, my stop loss just goes below the low of this candle. If I'm triggered into that trade and it doesn't work out, I realize that it ultimately hasn't worked out when price dips below the low of this candle. So always stop loss, using a stop loss, rule number 3, stop loss in a logical place, and that's just the logical place here, number 4. Now Simon is coming up with another great question here. In a logical place based on percentage risk, e.g. 1-2%. Now, if you read books, those books might tell you I want to close my position if price is dropping 5%. And we are just talking about price here, not about risk and not your account. I feel this idea of price dropping 5%, it depends on the volatility. For me, it's still somewhat a random place. A fixed percentage move in price is not really for me a logical place, because if you have a fast moving market, 5% can mean nothing. If the volatility is really low, those 5% might take forever. So percentage-based price move can be done better than not losing a stop loss at all, definitely, but definitely I prefer to have my logical place. Now, next point, and Simon's already following up on that, account value. Absolutely. That's our next rule here that we want to cover. Risk management technique number 5. I'm always risking a fixed percentage of my account on any one given trade. So if I'm trading with a 10,000 pound account, I'm willing to risk 100 pounds if this trade doesn't work out. So if this trade does not work out, my account will be down from 10,000 to 9,900. It's not nice that I will have lost money, but honestly, I don't care. This is such a small number. Does it prevent me, does it hinder me in any way to put on new trades, to trade the markets again, to put in just the next trade? Absolutely not. However, if I have lost 10%, 20%, 50% of my account on a trade, I will be in a really rough shape to come back. Because if I've lost 50% of my account, I now have to double the remaining account just to break even again. So stay small with your position size. And guys, position size will be next. Stay small with your risk exposure. The risk exposure is 1% of my account. You can go for 0.5%, you can go to 2% maybe, but the very moment you start to increase your position size, your risk exposure from 1% to 5% and beyond, if you run simulations, you will see that you will be in bad shape pretty quickly. Sure, it can work out. Can you take a 500 pound account and become a millionaire by the end of the year? Sure, it can be done. Can it be done reliably? Absolutely not. The risks that you will have to take in order to achieve this is just horrendous. It's just a very bad idea. Let's put it that way. Stay small, stay consistent, focus on making money in the long run. Today means nothing. And risk management is just here for your survival, to make sure that you survive today so that you're in the long run and be able to reap those benefits from trading the markets. Just reading the questions. Yeah, Simon is also bringing up the margin required to trade, and I've done some tests on this. What are the margin requirements? And usually I have maybe 1 to 2, 3 forex positions on at one time, something like that. And the idea here is you want to calculate your margin and know how much margin is required to open that trade. But what I found is if I do my position sizing correctly, and this is done based on this 1% rule, I never ever had any issues with margin and getting margin calls or trading too large, because the position size, the number of lots, mini and micro lots that you will place as a trade, this is really broken down and determined by this 1% risk. So let's have a look at this. Where is my entry? My entry is here with this horizontal line at round about $59.339 per barrel for per barrel crude oil. My stop loss is sitting here at 57.968. So if the market is moving against me, I'm taking a risk here per barrel for about, just a moment, the horizontal line is 58 and the other horizontal line is 59. I'm taking a risk of around about $1.40 per barrel. That's the risk that I'm taking, entry to stop loss. And now the question that I have to answer is, how many contracts can I trade? 10,000 pound account, I'm willing to risk 1% of my account. So this is a risk of 100 pounds. And the only question that I now have to answer is, all right, with a risk per barrel of $1.40, how many of those contracts can I squeeze into a risk exposure of 100 pounds? And once I've calculated that information, obviously I will need the US dollar to British pound, the cable FX rate for that to do. This is how I calculate my position size. Absolutely crucial. You have to have the position size correct. So if I'm triggered into the trade at that level, and I will be stopped out at this level, I should have only lost about 100 pounds. That's the basic idea here. Just reading the questions. Guys, sorry, just a moment. And by all means, keep the questions coming. It's just that my webinar interface is acting a little bit squiggly here. All right. Vandio is asking, how can continuous stops be prevented when trading a small account without increasing risk? Vandio, could you please explain what you mean by continuous stops? Continuously being stopped out, or how do you manage those stop losses? Is this a fixed stop location, or should I be using a trailing stop? Personally, I explained why the stop loss is here, because it's the swing, my new presumed swing point low. And that's the idea why I want that stop loss to stay there. Trailing this stop automatically up is just, the stops then suddenly starts to end up in a location which is just a random price. And for that reason, I'm not usually wanting to do that. I'd rather move it from proper swing point low to swing point low. So in this example, I'm triggered in, price is pushing a little bit higher, pulling back, moving higher again. I would not have been stopped out in this example. And then I can start to push my stop loss higher. The next new higher low would be for me this candle here. So once price made this new higher low, then I might be tempted to say, all right, let's just pick this stop loss and drag it up here just below the new higher low. This is how I would go about managing my stop loss. We talked about the trade plan, and I told you guys I need to have a complete plan. So also taking care of proper trade exits, and I always want to go for at least a 1-to-1 profit target. And guys, you can see that's the distance between my entry to my stop loss. Let's grab the hair pointer here. From the entry to the stop loss, and that same distance, which should roundabout be $1.40 here, is applied to the upside. So I know if price hits this price level, I now have roundabout a profit of 100 pounds. Why? Because same distance, 1-to-1 profit target. All right. Now the question is, how should I manage my position? Should I close the trade at 1-to-1? There's no harm in doing that. Remember, we want to have two components of having an edge. And the first component is we are shooting to win more often. And the second component is winning larger. If you say your batting average, for those of you into baseball, is so good that you definitely can nail that 60-40, 70-30. No need to go for 2-to-1, 3-to-1 profit targets. Absolutely fine to hang in there and say, I close at 1-to-1. However, there's a way to manage that position. And the idea here is that you could say, all right, 1-to-1, that's interesting for me, but I'm also shooting here for a 2-to-1, which should be somewhere around this area. How to arrive at that price? You just add another $1.40, the distance between my entry and my stop loss, to the top. And now Simon is bringing this already up. Can you trade a split? This is exactly what I want to do here. I want to split that position at that point. I'm still having my stop loss in this location, but I don't want to close my whole position here at 1-to-1. But why not close, for example, half your position? The idea is that if I close half my position, I have locked, if my risk exposure is the big letter R, this is my risk R. If I lock in half of my profits, close half of my position at +1 R, my remaining risk exposure is 0. I've locked in 1/2 R. The remaining risk exposure is -1/2 R. So if really bad things happen out now and price moves continuously from my first profit target to the entry and then to hit the stop. I should have lost close to nothing. I've won 1/2 hour and I have lost 1/2 hour, netting at round about 0. Of course, this only works if price doesn't gap, if there's no huge move with slippage and so on. You get the picture. But the idea here is at taking half my position off at +1 hour, I now have essentially a pretty much risk-free trade on. And if price starts to push further in my direction and hit my 2-to-1 profit target, I can easily sell the remaining part of my position. So I've locked in half of my position at +2R. I've locked in half of my position at +1R. And guess what? I've taken a total of +1.5 times the initial risk that I had on. And this is one smart way of managing your position and shooting for larger gains than losses while taking care of the downside. You have not only two categories of trades. You no longer have only winning trades and losing trades, but with this technique, you manage to move some of the losing trades into break-even trades, into scratch trades. And this, if you run simulations on yourself, play around with Excel or Google Sheets or something like that, and just play with the numbers and just test out when you move. Let's say you have 50% losing trades and you manage to move 20 percentage points from the losing trades bucket to the break-even trade bucket. What this will do for your bottom line when it comes to trading, it's tremendous. This is such a powerful risk management technique to do proper position management and scaling out of that trade when things start to move in that direction. Chris is asking, with the trade management, do you place two trades with 1-to-1 and 2-to-1 and just let the market run, or do you sit and watch one trade and close out half? For me, it's definitely in line with this plan your trade and trade your plan. It's definitely the first thing. I will be splitting my position initially into two trades, and one is already submitted with the 1-to-1 and the other one with the 2-to-1 profit target. Both take the same stop loss location. And that's it. So Simon agrees. That's the way he's doing it too. So that's personally, I don't want to watch the markets all the time. And that's the beautiful thing. If you have a trade plan and you just trade your plan, that you have taken all the necessary decision makings. The process is done the very moment you push the submit button. The very moment you submit your order, you have done all your homework. The only thing that you should be monitoring now is, in this scenario here, I haven't seen the breakout yet. The only time that I will have to do something manually is if price starts to move on sideways, hasn't triggered my trade yet, price is moving sideways, and suddenly price starts to drop below my stop loss location. I have not yet been triggered into the trade, but my stop loss level has been invalidated, and this would invalidate my complete trade setup. I would cancel both of those orders at that point in time and be done with it. Could still be that the market would still make a new higher low, but this would not be the new higher low, so that setup would be gone. That's the only thing that I have to manage manually. Of course, I want to be, if that trade is on the daily, I want to be aware of if different news are about to hit the wire. Going back to the financial crisis, I was very, very precise and diligent about closing my positions on Friday evenings. I did not want to have any exposure while Greece might be going on default. Brexit, you know the markets you trade, you know those events that can happen. Risk management only works properly if there are no huge gaps. Looking for good continuous chart structure, and usually Forex should be meeting all those requirements and be giving us those chart setups that we look for. One of the huge benefits that those markets are trading pretty much from Monday morning in Asia to Friday evening in the United States. However, markets can move fast, news can move the market very fast, and you will have a lot of slippage there. For those of you brave at heart, Just go back in time a little bit and look at every currency pair. Euro, Swiss franc comes to mind when the Swiss National Bank decided to suddenly drop the virtual floor that they had on the exchange rate. It was during trading hours, and bad things happened pretty quickly. Be aware of news. Personally, I don't want to have any position on when major news is about to hit the wire. Another part of risk management. All right, reading the questions, but I think the core questions have been answered here. And yeah, guys, by all means, keep the questions coming. Another question was, can you show stop loss in time frame M5 or no. You pick the stop losses. You pick the stop loss. Look, I'm looking here at a daily chart. I want to trade the daily chart. And therefore, I have picked my entry based on the daily chart, and I've picked my stop loss location on the daily chart. Let's just virtually move to any market. Let's pick the euro against the kiwi. Why do I like that chart? Why is this on my watch list right now? Well, we are in a trending environment again. And guys, you see this pattern happen all the time. What is it that we saw here? Prices making higher highs, pulling back to higher lows. What do I have here? I have a small bullish candle. Where is this small bullish candle? It's sitting in my moving average buy zone. What have the moving averages been doing? They have been fanning up, confirming this uptrend very nicely. Over and over again. You don't need to have 20 strategies. Have one strategy, have two, have maybe three, but become a master of them. Just like Bruce Lee once said, I do not fear the man who has practiced 10,000 kicks one time each, but I'm definitely afraid of the one who practiced one kick 10,000 times. Pick your battles, focus on your strategies, pick a few, and then try really to become a master of reading price action, understanding what that market is telling you here. So that's the basic idea. Where would be my entry? My entry would be just again, as always, above the high of this candle. My stop loss location would have been below the low of this candle, and 1 to 1, 2 to 1, that's it. But that's not the main thing that I wanted to show you guys here, but it just goes to show it doesn't really matter what the market is. If this was US oil, crude oil, or if this was now the euro against the kiwi, let's just drop down with our time frames. And I've not looked at those before. It's just now eyeballing things and trying to figure out if there's something that I like, that I see, in order to explain those ideas. Yeah, let's go for this 5-minute chart here. The question was, would I pick my stop loss location based on the daily? No, everything is coming from the time frame that I intend to trade. So I'm looking here at uptrending market environment. If you say, wait a minute, Philip, this is not really looking that strong as a trend, I completely agree with you. Price is pushing higher, pulling back. Obviously, this now would make for a very nice setup candle here, but the basic idea stays the same. Let's wait for the next pullback. The pulling back, is this a nice candle to trade off? No, because the candle structure is bearish. The long upper shadow here is rather disencouraging, which is the same thing for this candle here. Yes, the body is white, but the long upper shadow suggests to me rather a little bit more strength, a little bit more weakness here than strength. So that would not have been actionable for me. But just for the sake of demonstration, let's just assume this would have been my entry candle, so above the high of this candle, and just from this very same 5-minute chart, my low would be sitting just below the low of this candle. So I'm taking my entry, I'm taking my stop loss location, I know the distance now. How much do I want to risk? 1% of my 10,000 pound account. So the risk exposure stays once again at 100 pounds. And now I just have to calculate how many contracts can I squeeze in to that distance here in order to come up at my correct position size in lots, mini lots, or micro lots. Once again, 1 to 1 profit target, round about there, 2 to 1 profit target, round about there, and that's it. Question, do I wait for candle confirmations or reversals to place trades? I always trade based on closed candles. So I would wait for this candle to finish printing. I have seen so many times to change things, or for that candle structure to change big time within the last 10 seconds, even of an 8-hour candle. It takes so little, and suddenly what appeared to have been the perfect setup candle suddenly is just a huge mess, and you're stuck with a position that you really didn't want to have on. What I usually want to do is I want to prepare my deal ticket. I want to prepare everything. I want to have it set up with a proper stop buy entry price, with the proper stop loss location, with the proper trade size, and the second one for the second leg of this trade. All this is already sitting in front of me, and then I will wait patiently until this candle really is done. The next candle will start printing. And in this very moment that I see price opens here, and yes, this is truly the candle structure that I intended to trade, then will I push submit on both those deal tickets, and the orders are live and with the market. So always wait for candles to close to actually see what they will look like. The structure of those has changed far too many times for me in the past, and this is just a risk I'm not willing to take. So guys, so far we have covered 6 of those risk management techniques. What is the 7th? It's not so much about a proper technique on the chart, but it's mindset. It's so crucial to have the proper mind and to be in the zone when it comes to your trading. And my suggestion for you is be a stoic. There are things that we can change, and there are things that we can't change. And we can change everything about our trade until the point where we hit submit. We can decide actively for ourselves, do we want to trade this market? Is the chart structure good enough? Are higher time frames in agreement with what I'm seeing here? I just mentioned a few of the reasons or a few of the tools that we use in order to stack the odds in our favor. What is the big picture? Is it really a great, outstanding trade? A great trader once said he's approaching his charts and his setups with, if I was only able to put on 10 trades this year, I have a budget, I have a limit of 10 trades per year. Would I waste one of my trades on this setup? Is it good enough? Or am I waiting for something better? You really want to shoot only for the good ones. But all this is within our grasp. All this is something that we can control. The very moment you hit that submit button, there are things we can't control. The outcome of the trade, what the market is doing, if your stop will be picked or not. This is just no longer within our control. And we shouldn't beat ourselves up about the outcome of the trade. Trading becomes very difficult because as a pilot, you've landed the plane safely, so therefore you must have been a good pilot. As a doctor, you have cured all your patients, therefore you must have been a very good doctor. As a trader, I have losing trades, and still I can be a great trader because the outcome of the trade is something that I can't control. I can't control the outcome of one trade. I can influence and somewhat control the outcome of 100 trades, of 1,000 trades, because I've stacked the odds in my favor. I've developed a strategy. I have a trade plan and I stick to the plan. I go in there with consistent risk exposure and consistent position sizing. I've made sure that I win my setups more often than not. And if I win, I've made sure that I make more money out of my winning trades than I will have to pay on my losing trades. This is called in system development a so-called expectancy, or simply put, you have an edge with your strategy. This is your control. That one single trade, does it work out or not? Who cares? Who cares? It's about 100 trades, 1,000 trades within a proper strategy, not shooting from the hip and acting on a gut instinct or feeling. No, your strategy. But then be stoic. Do not care about if that trade works out or not. There are things we can change and there are things we can't change. So wrapping up today's session, stacking the odds in our favor, plan your trade and then trade your plan. Always use a stop loss. You want to have those stop losses in a logical place. You want to have a risk exposure of just 1% of your account. And using your trade plan with proper entry and stop loss location and the money risk, 1%, 100 pounds in our example, you can now determine the proper position size for your trade. And once that trade is on and live, be a stoic. Things are there that we can change, and there are things that we can't change. So that being said, let's just quickly jump back here to our slides and wrap up tonight's session. ATFX has brought to you this session today. So why should you consider ATFX as your broker? ATFX are regulated by the FCA, the Financial Conduct Authority. You see the license number. Can check and double check that ATFX truly is a good and solid business partner, an efficient, secure, easy to use payment portal. ATFX is committed to providing competitive prices for our clients. Global investors, most widely used trading platform, MetaTrader 4, bespoke customer service and trade support for all client trading needs 24/5. And the effort shows, you can see here, winner online personal wealth awards 2018. And guys, as much as I appreciate that efficient and secure, easy to use payment portal, if you ever get a margin call, something went wrong with your risk management. At that stage, I would step back. I would definitely take it easy and rather look into what's going on there. If you do everything that we covered here today, you should never ever get a margin call. And if you do so, I suggest not to answer it, rather step back and realize what has been gone wrong. Just my 2 cents here. And yeah, so final wrap up. If you want to open an account, you see here the contact details and ways to be in touch with ATFX. And yeah, if you happen to have any further questions, just shoot. Guys, thank you very much for the feedback here. And yeah, perfect. Seems we're good. I think there should be a survey coming up next, and any feedback that you have for us in order to improve those sessions is really appreciated. And now to all of you, a very nice evening. And to those of you into football, great night already yesterday, and I'm keeping my fingers crossed that your favorite team will also be coming up tonight as well. Guys, thank you very much. Very nice evening. Happy trading, and catch you next time. Thanks again, and bye-bye.